into trading that there's an element of gambling to it. It's just that you're on the positive edge versus the negative edge. But people would see it more professional back then. They understood, where now it's almost, how can I gamble and how can I gamify that? And I think that's a terrible attitude that will eventually fall. In 6 months, I've seen, just by looking on Twitter, how it's gone from prop firms you would try to get capital, scale up. Now you can buy yourself into being a 7-figure trader.
True, without evaluation, yes.
Which is a false sense of identity, because if you call yourself a 7-figure trader, by definition of just buying your way in, it's fake. What I do see in the industry, which is laughable to me, is I want to trade 100% mechanical and then I won't have any psychological issues. If that was the case, you've got ICT. And if it was that easy, you take any intelligent person that's competent to learn and go, right, when this happens, do this. Fine, do it. Why do you lose your account after 60 days then? If you remember the early SMC days when it was the 40% in the morning before you've made your scrambled eggs, it was this facade. But then FTMO would come out and say, hey, our top traders are making 3% per month. So where are the 40% before they've had their breakfast? And what it done is that it made 10% a month seem like it was average when it's not.
What would you say for a trader of what is realistic in terms of what is a realistic win rate? What is a realistic risk to reward? What is a realistic gain, trade frequency? What is normal and in a professional approach that you've seen?
Realistically.
Ladies and gentlemen, welcome back to another episode. I'm joined by Mark Hutchinson. So he's been around in the industry for longer than anyone I can really. I've been following you, Mark, for probably since I started in my own trading journey. I saw you're a prominent figure, especially because you're from the UK. And now that I realize around the corner from where my family is, it's a pleasure to have you on. And thank you for giving the opportunity to a smaller channel. I've seen right now you've been in Dubai doing a mastermind. So how has that been?
It's been exceptional. It's been a couple of days, so only a very short trip, and thank you so much for having me on. The podcasts that I've seen so far have been phenomenal.
Thank you.
And your interview skills are exceptional.
I'm sure we'll have a good conversation. Thank you, bro. So I want to give you an opportunity to have a brief introduction of yourself. You mentioned you've been trading for 15 years. So since your late teens, you've been involved in the trading space, and then a prominent figure more on social media for 7-8 years or so.
Yes.
So talk to me just very briefly about your beginning days, and then we'll jump into some deep topics.
For sure. I'll keep it very short and brief, but essentially I got chucked in the deep end. Very different type of industry back then. I was an engineer, studying to be an engineer, kind of going down the typical route. Very much family precious to do that as well. Brother's an architect, that kind of certificate-based route. Got made redundant. Okay. Had a few bits of savings, saw a seminar in London, decided to go on a 2-day kind of experience, 2-day course, started learning how to trade stocks, and then I started from there. So after a period of time, built up some capital, lost all of it, broker went under liquidation. Then I just thought, right, can I apply the same principles that I'm learning in the stock market to the Forex market? Because there was Forex courses at the time as well. Yes. So I thought it must be different. I'm very new to this industry. I remember earlier days thinking I want to be a stockbroker, and you don't really understand what that actually means. So I really just stuck at it for long enough to figure out my mistakes, simplify the way that I trade. And as I got more and more experience, my charts just got cleaner and cleaner, and I found an edge. But the origin of how I trade still started with stocks. I've just developed it and then simplified it.
Why did you decide to pivot from stocks to trading Forex?
I think it was the bad experience. It was more trauma related than logical at the time. When you build up an account, it was only 10K, it wasn't huge, but at that time, that was a lot of money for me. And I remember it was MF Global. I'm not sure if you remember them, but at the time, huge company on the New York Stock Exchange. And I got a call from my brother. He said, can you log into the account? I was like, what's happened? And then I realized I couldn't get in, and then it was just finished from there. So it leaves a bit of a bad taste in your mouth, and you think, right, I'm at risk here. These are things that I don't understand. What if that was 100K? Because really and truly, I built that account incorrectly anyway. So it was almost like the market doesn't let you get away with anything. And if it was that experience, it'd be something else over a long later down the line.
Yeah, you can't. There's no accidental profit in the market. So you mentioned off camera just now, you feel it was an advantage to start at the time that you did, because everything has changed now. And I want to touch on that because it's an interesting comment or reflection to have, where myself, for example, I got into the industry because of what I was seeing online. And I think everybody more or less gets into the industry through what they see on Instagram and social media, because trading is not one of those things that anyone has a burning passion for from the outside. When you get into it, that's a different case. But from the outside, it's not the most glamorous or interesting. It's very niche. But I think people get into it for what they see and maybe align with their goals of financial freedom and so forth. away from social media and the situation you were in when you were first starting, what is it that called you to trading in general?
Again, it was being in that situation that when I was made redundant, I realized very, very quickly, there is no security here. So you're conditioned to think, get a job, it's safe. Anything else is a risk. And I thought that, I was sucked into that. As soon as I was made redundant and I saw these top engineers, principal engineers, like really on high pay at this point, like 80, 100, 120K, they're on like 6-figure salaries. They're walking out with a box in their hand and they look lost. I thought, I never want to be in that position ever again. So I don't want to then now apply for an architectural practice where I could get away with, you know, becoming a junior, work my way up. I don't want to do that. I need to find something that is going to give me freedom. Not so much money, freedom. And I think that's where my advantage that you touched on came in, because I wasn't actually looking to get into trading to make money. I knew money was available, but at my limited consciousness at that point, I was thinking, if I can just make $3,000 a month, I'm sweet. That
the
would
low
take care of that.
expectation helped, probably, yes.
Versus what you see on social media, it's 30K withdrawal from FTMO, 20K here.
That's a Lambo in the first year.
Yes. Yeah.
So because you were in a more of a unique circumstance when you were first starting off, and then you see new participants coming into the market all the time, what kind of a difference in attitude and framework do you see between people from your time when they were first starting out and the newer traders coming into the industry?
Very simple. You knew when you got into trading that there's an element of gambling to it. It's just that you're on the positive edge versus the negative edge, right? When you've got a system and you understand what you're doing. Yep. But people would see it more professional back then. They understood, where now it's almost, how can I gamble and how can I gamify that? So the attitude is completely shifted, where before it would almost be taboo because you wouldn't want to bracket yourself as, no, I'm not a gambler, I'm a trader. And I understand that, and I would feel exactly the same way. Because when you've put years in and someone says, oh, so you trade, so you're a gambler, you would think, no, I'm not a gambler, because there's a lot of risk assessment that goes into this. It's almost a bit of an insult, where what I see now is people are very comfortable and will glorify the gambling. How can I gamify a prop firm? Yep. And I think that's a terrible attitude that will eventually fall.
What do you think is the major defining traits or approaches between somebody that is more in the gambler's area, and there's ways that gamblers are making it work, maybe not on a 10-year horizon, but to gamify the prop firms, there's ways people are doing it, but it's instilling certain habits or ways of approaching the market, which is in a gambler's box. I want you to talk me through what is gambler's box versus what you would consider more of a long-term sustainable or professional approach.
That's a good question. I would say, and what you refer to is that I don't want to confuse the small percentage of people that can do it, because I know some of them that can do it and can do it very well. However, I often refer to it as that these exceptions do not define the rule. Yep. And as a person of influence, I think more of these individuals should take more responsibility to understand that you're a niche, you're a 1% individual that has the personality to do that. You know, there's only a very small percentage of people that can even play with numbers. Some people can decide, right, I'm going to risk 3% on this trade, but then I'll risk 1% on that. To me, mathematically, that makes no sense whatsoever. But I also have the awareness that if I wanted to do that, I could do that, but that's only through experience. So you imagine a beginner and learning from these people, going on Twitter and following individuals, they're listening to them thinking, I can do that. Yeah. They can't. Trading's difficult enough as it is, and then you want to play with the numbers, because at that point you're saying, you know every single outcome of the trade. Because we bring probabilities in and understand that and accept one bracket and say, right, you don't know the outcome of the trade, but you'll take the setup over and over again. Yet now you're quantifying the value of the setup, saying, well, this is an A+, so I'll decide to risk 3% on that. But you know it's not absolute. So someone who's been in a game will understand intuitively how to do that. A beginner cannot. They're trying to get consistent as it is. Then they're playing with risk. So you imagine they take that trade that they class as a setup and they think, I'll do 3% on that. They take 2 of those that were actually really good trades. They just happen to be 2 losers, but they're down 6%. Their mindset's all over the place. So I would say that's one element of it. The other side of it that puts them in the gambling bracket is really just who they follow, who they're influenced by, because they're seeing too much of the gamification. I think it's more not process-based, it's more circle-based. So it's where their attention is. And in 6 months, I've seen, just by looking on Twitter, how it's gone from prop firms, you would try to get capital, scale up. Now you can buy yourself into being a 7-figure trader.
True, without evaluation, yes.
Which is it's a false sense of identity, because if you call yourself a 7-figure trader, by definition of just buying your way in. It's almost, it's fake. And then you identify as one. And then when you lose that capital really quickly, I actually had a trader not that long ago, 1.6 million in capital. It's gone.
Yeah.
How can you be a 7-figure trader and then next week not, just from drawdown? You know, and I think that part of gamifying it too much, not focusing on the actual process things that professional people would do, and not really treating this like a long-term business. I would say that's the biggest thing.
You mentioned the idea of A+ setups and managing risk accordingly to your models and setups. And it's an interesting point because I've had debates on this topic exactly. And on a roundtable that I did on Riz's show, it was a long discussion that me and Umar Ashraf had. And I was on the side of the fence of, I have models and I know the data of my models. But I've just been in the frame of I'm always going to just keep risk management set. And there's variables we can play with those. There's plates you can spin. And I prefer to play with the risk reward or profit management or win rate, which is choosing the models. But I didn't like to spin the plate of risk management. I like to keep that fixed. Are you therefore more on the side of risk management is something that should be standardized across, or would you double down on a setup, or maybe not on a specific setup, but maybe in a certain situation when you're more in profit or you're on a win streak, or is there any adjustments you'll make to your risk?
Yes, so you touched on the word situation. I think it's situational. So standardized in the sense of you getting to a certain level. So let's talk from a prop perspective, because I believe it's the most relevant as to what people have access to. You can risk a certain amount. I'm not talking about the 4% to fluke an assessment. Like, let's say you do it properly, you've got the capital, you're now in profit. You can set a rule. A lot of our traders do this, where when they're up over 2% in profit, they can then risk 1%. They risk 0.5% all the way up to that. But then you also need a recovery metric that if you go back down, you're then lowering the risk. So just from a common sense point of view, you want to keep yourself in the game. And I'll explain why it's important. And it's less about risk and more about your association of prop firms. So let's say, for example, you're someone who's done quite a lot of assessments. If you remember years ago, and I'm talking about the earlier stages, a common thing would be, I've blown 20 accounts, and they almost wear it like a badge of honor, thinking there's no detriment from a mindset point of view. You will associate yourself with that and you'll get comfortable with it. And the reason why you will is because if you've blown 18 accounts, you're almost immune to it. Now, I know this idea of,
or desensitized,
get knocked down 7, stand up 8. That applies that applies to certain things, not this, because I don't think there's a net benefit to doing that. Because let's say, for example, you take a trade you're not particularly happy with, and you've blown 18 accounts at this point. You're very comfortable losing accounts. You get very good at it. So you're going to go on tilt very quickly, and then sabotage faster, lose the account almost from a sense of relief. Okay, but I can start again. But now you're so comfortable doing it, you do it again and again. And that's why you see people have got 36 accounts. It's insane to me. Yep. But before it was the blown account. So like you would blow your personal capital. Now you're comfortable. It's just past different
because
disguises.
There's less repercussion. Yeah. You know, they say, and I see what you're trying to say of there's elements to life or just approaching success in general versus approaching success in the market. And they don't always communicate. For example, if I'm someone that wants to possess the trait of patience or resilience, I'd probably want to go through hardship to develop the traits of patience. If I have a comfortable life, I'm not going to be a patient or resilient person. So it's kind of like you have to experience the opposite to achieve the trait. But you're now more saying that to achieve certain traits in trading, going through hardships or going through blown accounts actually instills more trauma. So talk to me about that, because I feel like this is a topic you have extensive knowledge on, especially because I've seen your series Rewired. More on what is major traumas or major things holding people back in their mind, specifically in the trading space when they begin and as they develop as a trader.
Number one, their association of what trading is. So that plays a huge role psychologically. Whether they're conscious to it or not, it's happening. So for example, I'm curious to you, when you hear the term Forex trader, what comes to your mind? Is there any like images that come to your mind straight away of like how you visualize that?
Yeah, when I look at the industry as a whole, I see somebody that's chasing a dream, chasing a lifestyle, and it's very, very money orientated, but I think more so it presses on the emotions of insecurities of men. So what is a young 18-year-old guy insecure of? It boils down to a few very simple things. One is like their status and their presence. One is maybe even women. And when you start to see that Forex in their mind will help them achieve the things that they are feeling like they are lacking, where money can solve this problem, money can give me status, money can help me buy a car, money can help me have access, all of these things is more like you're trying to embody what it means to be a man, but as a shortcut through the industry, as opposed to going through the hardships that it takes to possess those things.
Yeah, I completely agree. And because of that image right there, every single action will now be dictated through what that means. So let's say we add a few other images in there, like to be a Forex trader, that's someone that will probably take trades. They're quite active. They take trades a lot. So you're more inclined to only feel like a Forex trader when you're trading. But we know a position is not being in the market as well as being in the market. But if your imagery is, no, Forex traders, they trade, they're in the sessions, it's quick, it's active, it's fast, you're going to be inclined to have an itch to want to be in the market, force trades, revenge trades. You're going to be looking for stuff that it's not even there. And the only way that you feel alive is when you're in the markets. And that's why these people, and you can see it in the data. So this is not even my opinion at this point. All you've got to look at is the numbers and look at the emotional decisions that people make. And you'll see there's actually so many competent traders that could be great, yet they cannot control their impulsivity to just find a position. And then they get comfortable making the mistake to then just do it again and again. And they almost know they're going to do it. They do it to then mess up, to then reset again. And it's this vicious loop. It's the reason why that people get the biggest payouts on prop firms. They'll lose it 60 days later.
Yep, that's the stats.
They can't all have a technical problem.
That's true. So I'm seeing that you're cautious, or you want to put a disclaimer out to specifically prop firm traders, because they can habituate to losing an account. Whereas if you deposited your real money, you would feel that, and it's not something you can really acclimatize to, losing your real money. But blowing another challenge, it does build an idea of whatever, and let me go again, especially when people see the gamification element of, do the risk reward of the challenge fees. I might put $10,000 into challenge fees, but if I can get 100,000 in payouts, I've got a 1 to 10 risk reward in the gamification of the model, but that doesn't always instill correct approaches. Do you feel like there's other similar detriments that a prop firm trader will have over a traditional broker, real capital trader, as opposed to a prop firm trader? Because one thing I have seen, for example, the leaderboards on prop firms, that doesn't need to be there. And I did question, why is it even there? And yes, it's a marketing gimmick for the prop firms to speak about, but reading between the lines, that is more that thing I said of men are chasing status, and this is a male-dominated industry, and they are seeking approval externally, and whether that's through materialistic or maybe now even they're doing a route in life that they maybe aren't the most supported in. You left engineering, I left dentistry, and a lot of guys maybe are just trying to prove it to their parents that this is going to work. And the moment you have a leaderboard and a certificate, that is more like you haven't really achieved too much yet. You're not full-time, you haven't even taken a payout, but you've got a certificate to show people that I have achieved something, or the accolade of 7 figures in funding. Is there other pitfalls or psychological burdens you're seeing specifically in prop firm traders?
The leaderboard that you touched on is a huge one, because that's become the biggest flex, where people on the tip of their tongue, it's like, but who's on the leaderboards? Yep. So that becomes, as you said, status, and I think that's what they're chasing. But they're chasing the wrong thing. The same way the goal is to be rich, not look rich, right? That's something within itself, where people will go out of their way to try to look rich versus be rich, and they would prioritize at their own detriment. So when we understand the psychology of men, because of the status part, they will do things that are not within their favor just to appear more successful. And even if it's buying loads of accounts, going high risk on a few trades, and it happens to work out, and you see your name on that leaderboard, that is enough validation for you to go, I'm the fucking man. But the reality is, you've got loads of debt, you're all over the place, you've got no assets, you don't have a plan, you've got no goals, and you actually haven't structured your life. But to the Twitter world, you're the GOAT.
Well, is the dichotomy or the false belief that someone on a leaderboard and therefore the abnormal gains are the ones that we should strive to achieve, which is not realistic on a long-term horizon, because as you said, the stats show that they don't have that account in a few weeks later. I want to touch upon the idea of, I think a lot of people arrive after a year or less than a year where they start to understand what are the emotions of a trader, or what are the negative repercussions of these emotions. For example, they'll know by now, I will face greed, I'll face fear of missing out, I will revenge trade. And these are things that is very easy to arrive to. But the challenge becomes once you're aware of it, once you even know what they are, even if you've recognized I do this, I'm on a losing streak, but I'll still take trades and keep losing. I think a lot of traders arrive at that point and they don't know how to address it apart from what they hear on the internet, which is let me meditate, let me journal, and let me go to the gym to release. And that is all maybe scapegoat kind of mechanisms of I'm feeling an emotion. I don't know how to deal with it, process it. I don't know where it's coming from. Let me go to the gym to almost suppress it. When you see people or in your own journey, you face certain emotions, how did you deal with them, especially the most common ones like greed and fear?
So I approached it from a very practical, more of a neuroscience point of view. Because as you said, all those other things, they're just escape mechanisms. They don't deal with the root. Yep. So the average human has roughly like 60 or 70,000 thoughts every day, right? 90% chance it'll be the same the next day. So if you don't change the way you think, you just repeat the loop. Right, you just repeat the same thing because you think the same.
You're in a paradigm, yeah.
So you literally have to reshape, rewire. That's why we created it. Rewire the way that you think. And the only way to do that is to follow a specific formula. You can't think that more market experience is just going to deal with greed better. I would agree that over a period of time, yes, you become a little bit more numb to it. But if you've got incorrect form, you're just going to get injured with more weight. And people are not understanding the detriment. Like you will go unpunished for a long time. If you're squatting 10 kilos, you squat 10 kilos for years and no issues. The moment you put 100 kilos on your back and you don't know what you're doing, your back's gone in just one decision, right? So I see it the same way. So I've approached it from, right, how can I interrupt those negative thought patterns? How can I bring awareness to why do I even respond the way that I do? Why when I'm driving the car, that if someone doesn't wave me through, that ruins my day and I've got anger. We're not understanding that everything is connected to everything else. So how you are outside of life is exactly how you're going to be in trading. And we don't want to address that. We think, right, what I do see in the industry, which is laughable to me, is I will trade 100K because my psychology doesn't get affected at 100K, so I'll just stick there. Or I don't want to deal with my psychology. Or I want to trade 100% mechanical and then I won't have any psychological issues. So that doesn't make sense because the data would show, if that was the case, you've got ICT. That's more mechanical. I mean, I don't know the ins and outs of ICT, right? I have a rough understanding of the trading method. However, if we're going to go with, well, it's mechanical, then surely the numbers would reflect that people wouldn't be making emotional decisions. Because that's the questions I get. Right, Mark, I trade this. You seem a bit too discretionary. So I want something that is 100% mechanical. So, okay, fine. So you're essentially playing poker with your cards face up. Because it can be reverse engineered. And if it was that easy, you take any intelligent person that's competent to learn and go, right, when this happens, do this. Fine, do it. Why do you lose your account after 60 days then? The data doesn't support that. The same way when, if you remember the early SMC days when it was the 40% in the morning before you've made your scrambled eggs, you know, but it was this facade. But then FTMO would come out and say, hey, our top traders are making 3% per month. So where are the 40%, you know, before they've had their breakfast? And they would laugh at and what it done is it made 10% a month seem like it was average when it's not. And then they started, and that was the problem. But the same individuals that created the problem have now changed their mind. So the same people that was pushing that narrative are now focusing on, don't worry about big returns. Focus on small returns. So it's interesting what I notice is that, and I don't think it's malicious. I think it's that they've realized as they've scaled up, maybe they did catch a few of those trades, go from 100K FTMO to 400. And they've sat there and thought, I can't put a 2-pip stop on this because I actually want to take this seriously now. So why is it when the capital increases, so does the stop?
Behavior, yeah. You know, it's also maybe a case of the pendulum swings and it goes from extreme to extreme in the industry. And because you've been around long enough, you've seen those full swings. And that could be from a perspective of marketing too, where at the time people were struggling with X. So the pendulum swings in the opposite to bring those people in. When people are at that side of the spectrum, they're like, okay, well, it's not as green as I thought it was. Let me swing back the other way. So when the pendulum does swing back and forth, there is a point in the middle, which is things that are more or less evergreen or more sustainable models that are not on the periphery, that are more marketing sentiments. What would you say are those things in the middle that are more tried and tested or reliable, down to what is a realistic win rate, what is a realistic risk reward, what is a approach to the market that you would say as a new trader, this is the best place to put my attention and efforts into?
I would say you have to follow money flow. So number one, from a strategic point of view, you need to know where the liquidity is. You need to know where the most of the volume is, where the bigger players are getting in. I'm always in agreements of that, because some people have a misunderstanding as to how we trade, when there's probably a lot of similarities when it comes to things like SMC, ICT. You may just call things different names, but fundamentally we're in agreements that we want to be on the right side of the money. What I think traders need to have in place is good risk model, right? And you can play with the risk when it comes to prop firm capital, but do it from a position of profit. Have a recovery plan. Like, have things in place that if you go below break even, don't just become the trader that just goes, right, oh, I'm blown it now, and give yourself permission to just become more reckless and then lose the account and just repeat the loop. So like, have something in place. And it can be, look, when I go to break even, I go 0.25% and I build back up. But the problem is that if you're fundamentally put in a timeline on when you think that you should make it, because you've told your friend that you're going to be a 7-figure trader at the end of the year, you're going to force that timeline. So firstly, just get clear on what that is and actually write it down. Don't just say it, because you can't work from just your mind. You'll forget. You have to work from documents. So I believe, think about it. If you was creating a business plan, you would write this out. You'd be like, what is my risk profile? And you'd write it all down and say, I've got to stick to this. I've got to be disciplined, because if I can't keep to my word, what can I keep to? So you do that, number one. From a profit target point of view, there is an element of, if you're risking 2-to-1s, 3-to-1s, which I know people have done it successfully, but exceptions don't define the rule. And I've not seen many people at like a mass scale pull that off and then get into drawdown and then get out of it, because they end up blowing it. Because what happens is that they intuitively know that I should limit my risk a little bit, because I was in profit, I'm risking, let's say 1% per trade. They just happen to take, and they might be good traders, they just happen to take a sequence of 8 losses. They're now in drawdown. And they're thinking, right, I'm taking 2-to-1s and 3-to-1s, but I'm risking 0.25%. How long is that? It's a very tedious, boring process. And then they end up just thinking, this is too boring. Let me just do something high risk, ruin the account and reset. And then the loop starts again and again and again. So I think there are some adjustments that can be made when it comes to understanding the higher time frame narrative and just holding some of those trades a little bit longer to allow and compensate for that drawdown period, which inevitably will come for any strategy. I would see traders that would show me they don't really understand what the higher time frame is. And I'm thinking, you're pretty switched on when it comes to all the intradays, but you're not looking at the 4-hour and seeing a simple 4-hour structural low that you could just manage that trade a little bit better. Like EU is a great example. I don't specialize in one currency pair, but I can trade euro dollar very, very well. And then recently we've had a lot of traders that trade those type of strategies come over to Rewired, right? Because they've understood I kind of need that psychological training. And then they would just ask me questions, what do you think of this? And I've never been the type of trader to say like, look, you trade SMC, so you can't be in Rewired, and then we're going to, strategically try to convince you to come to Falcon. It's really not that angle, because we actually want those traders to trade on our fund. So we're allowing a certain amount of people to trade on our in-house fund to hedge that risk, whether it be a more aggressive or more conservative style. So we don't advocate for trying to, get you into Falcon. Like, you trade well, great. We want to make some adjustments. But what was interesting about it is I looked at a lot of euro dollar trades, because I understand euro dollar or pound dollar is going to be the most dominant one. And I would zoom out and see so many of these trades where we've actually entered at a very similar point, yet managed differently. You would have just added another 4 or 5%. But there wasn't much risk to it, because you had the money flow, 4-hour, right? You had momentum on your side, and you're almost cutting the trade out of, you've got this mechanical approach of 2-to-1s, 3-to-1s. And I understand that will work until it doesn't. But I only think a small percentage of people that can pull it off, and you maybe know some of them as well, and they do it very well, and that's fine. But for the majority, they struggle with it. And I've seen the same conversation, worded differently. I'm deep in drawdown, and now I'm risking 0.25% or 0.5% to get out, but I'm only focusing on 2-to-1s and 3-to-1s. And I've been in this for like 6-7 months.
This topic is very interesting to me, of risk management. So you've kind of alluded to the fact that you'll have a certain risk when you're trading normally, but when you enter a drawdown period, or maybe you're on tilt, you should pull back on your risk. And then you've also identified the equivalent problem that arises, which is Therefore, you're stuck in drawdown for so long because to climb back is taking longer. And therefore, the emotions that come alongside with that newfound problem, which for me, I've always kept everything standardized. I don't want to, on a winning streak, increase my risk or double down, or on winning models, put more risk on and put my size on. There is the argument that Umar was also mentioning to me that, well, how do you plan to scale or, really go aggressive, or not aggressive, but more compound your account, whereas mine might be more linear. He'll take a more build a buffer and then go exponential by the end of the year and then start again and refresh the year, whereas I try to keep a more linear approach. For that, I don't think there's a right or wrong, but it's for a specific kind of trader,
personality
specific person.
difference.
So for me, I've kept it standardized because I've seen that if I'm on a winning streak, or if I have a belief in this model, or even if I have data that this kind of trade model is a more winning one, and then I increase my size on that, and it just happens to be this is the losing situations. Let's say I have 80% win rates on this model, but I'm going through that 20% losing period. Our wins and losses are randomly distributed, so I can't say the wins will come first. It's mixed within. Maybe I'll get a series of losses back to back. So if I've increased my size and I'm just happening to go through more losses, and then I've reduced my size on the trades that are going through more of a winning period, I've now thrown off my portfolio just through adjusting my risk and the emotions that might come with that. And then also through a losing period, if I reduce my risk, it's a bigger mountain to climb. Why do you believe it's important to modify your risk, especially when you're in a losing or drawdown period in your account?
The number one reason for that is to keep yourself. So my point of view is that I don't want traders repeating the loop of just losing and getting comfortable with it, right? Because if you do that, what the risk profile does is it allows them to stay in the game. And sometimes them staying in a game is more important than the actual numbers that you're talking about. Standardize it as much as possible. I mean, me personally, I'm not playing with risk that much because I'm sticking at 1% all the way through. But if I was on a prop firm, then I would 100% be incrementally scaling up, but I wouldn't go more than 1%. I wouldn't then get to 5% and go, right now I can risk 2 and play with those. I would just at least have a recovery plan. But it's not to actually keep the account per se. It's more so to just don't get comfortable blowing loads of accounts. And sometimes what you'll learn in that period of controlling the risk, it allows the trader to emotionally embrace the fact that, look, you're in drawdown, don't be reckless now. Can you keep your discipline? So it's less about what the numbers do and more about the traits they develop in that period. And we have that a lot. We don't have reckless traders. And that's what I would rather prioritize that, because I believe they have a greater chance to eventually succeed.
Yeah. So there's another comment or a feeling I'm getting, which is you're not a too fan of a mechanical or discretionary approach. Am I correct in saying so?
So the mechanical approach, I've always had an issue with it from the emotion part. I agree with it from a perspective of you should have a mechanical approach, right? But when people hear the word discretion, they think it's guessing and they're confused because discretion is interpretation of the situation. So for example, where do I gain an advantage if I'm looking at the same thing the same way, right? You could take the same trade in the same area and you might make more profit than me, right? Because I've managed it differently, but we might get in a similar area. If there's no element of discretion in that interpretation of that moment, you can't allow that to play out because you just have to do the same thing like a robot. But we're humans, we're not robots. And you'll never be a robot. And that's why there's so much emotion. What I find is that when I talk to a lot of mechanical-based traders that are obsessing over it, because I understand why they want it. I would want it if it could be 100% and there was never a moment that you made any discretional decisions. You would remove all emotion and everyone would just get rich. But that's not the case. So I think you gain an advantage about learning how to interpret those scenarios and trading the situation better. And I think a lot of the top traders that do trade, well, they say they trade 100% mechanical, but there's a lot of an intuition that comes into the play. I'll give you an example. Someone told me this. They said, look, I trade 100% mechanical. They put out a trade and they shared it, and then they got a lot of backlash. And they got backlash because he changed what he wanted to do on the stop and he considered another variable. Why? And I said, there's nothing wrong with what you've done. But you're saying it's 100%, but you're making adjustments based off of the situation because you factored in the higher time frame. And then you factored in the session and the timing. So you're making discretionary decisions and you're not even aware to it. So I think that emotion's always going to be there. Discretion's always going to be there, but it should be a very small amount. I would say if I was to ratio it, I would say I'm 95 mechanical anyway. So so a very, very small percentage where I will interpret that scenario, and that's where I gain my edge, because I can actually interpret that scenario and go, right, in this situation, I'm either, let's say, for example, euro dollar, before we had the bigger sell-off that was selling off for a while, we was monitoring that move when it was breaking the highs, and this is on the daily time frame. After about 6 weeks, I'm not going to trade euro dollar the same way at the top or at the bottom. Okay. Because at this point, I'm approaching areas where there's deep consolidation. It means I'm going to manage it different. I'm going to be more aggressive. I want to be in and out quicker than what I want to be at the top, where I can hold it a little bit more looser. For someone, that's uncomfortable for them because I don't want the discretion. But we're in the same agreements. We're just maybe managing different. I would say that's the biggest thing. It's actually less about the execution, because our execution is very mechanical. We're not just approaching an area. We're looking for specific things. Break of high, break back in. Someone will call it a liquidity sweep. I've been calling it something else for a long period of time. It just doesn't sound as fancy. Okay. And I think that's where the crossovers happen.
Where do you think this belief comes from that subjectivity equals randomness or not good, and objectivity and mechanical equals better? Where is that coming from?
I think it's rooted just in our beliefs of how we live our life. The same way, you don't cross the road without looking. You wouldn't go, right, 9 times out of 10, I'll be fine. You would always look. So we seek certainty in everything. We want absolutes in everything. And I get it, but that's the animal instinct mind. It's very difficult to shy away from that. Like the trader brain, you don't arrive with a trader brain, you have to create one. So this idea of not working on psychology doesn't make sense, because the top traders in the industry, right, even when you look at people like Richard Dennis, right, these top traders that have even had really poor strike rates but have made it work. There's actually a story about Richard Dennis, who he was trying to teach people his system. He had something like a 10% strike rate, but he couldn't teach it. No one could do it. And it's you have to do a bit of digging and a bit of research. And he was a phenomenal trader, right? Made millions and millions. However, wasn't able to help someone replicate it. Why? Because most people couldn't walk around with a 10% strike rate and perform, because you'd be all over the place. You'd have to be comfortable in deep drawdown all the time. And then your winners would have to run so big, and you'd have to be aggressive at the right times to scale in and be comfortable with that. And most people are not. But going back to your question, to keep it brief, is I think we're conditioned at every level to just seek certainty because we want to be safe. And having any element of discretion makes us feel unsafe. So we have to go to what is 100%. I want something, I want to know every variable, but the market is random. Yeah. So seeking that, I think, is actually not healthy in the first place. Be as mechanical as possible, but you can allow for 1 or 2% of interpretation, and you actually gain an edge there.
Yeah, I forgot the name of the book. It's something Zen. Maybe you know better. It's a psychology one on trading. I read it a while ago, and he said that every trading emotion can be boiled down to you want to avoid an unfavorable outcome. Whether it's I don't want to blow the account, or whatever. It's avoiding an unfavorable outcome, but everybody enters a trade thinking they're going to win. Otherwise, you wouldn't enter it.
Of course.
If you thought you're going to lose, you just sit it out. So there's that complete opposite end of the spectrum where undesirable outcome, but you're feeling more certain. And that's the space where psychology and problems arise. I'm starting to understand now your approach to the market is more mechanical for your entries and the strategy and the confluences, but you leave subjectivity open in your profit management.
Yes.
Is that so? Okay, so this is where I was in my trading for majority of my career, which was the first 5 years. And I felt fine. Like I thought this is the correct approach, because let's say I'm holding a trade. I thought, let me make it to a structural low before I take a good volume off, because it's bearish. Let me make a new lower low. Things like this. And it was always price action based profit taking. And it was working. And there's only until I really reflected on my data, and I've spoken about this before, where I realized that there is, when I have my full winning trade, it will follow my price action approach, where I've hit my final TPs because everything did what I wanted to do. But that's not the normal case. It's not like 100% of the time. It's more of an outlier. It's maybe 10, 20% of the time it reaches my final TP. So losses aside, it was more how much of my winners, how far do they go? So there's certain trades that maybe only go 10 pips in profit. That was an outlier. There's certain trades that went all the way to TP and beyond. That was an outlier. And it was a bell curve where the majority was in the middle. And when I reflected on my data, I realized, well, if I'm taking a price action based profit taking approach, I'm optimizing for that extreme, which is the ones that go to final TP and beyond. And that is out of my control. But if I look at the data, that is more controlled. And I realize instead of optimizing for an individual trade, which is an individual trade's optimization is holding full volume to the final TP, 100% volume at that final TP. But what about all the times it doesn't reach that? That is what you're trying to avoid. So when I started to think, okay, well, I'm not optimizing for an individual trade, because if I was, the best thing to do is 100% volume all the way. But you don't. You take partials along the way, because there's situations where it doesn't do that. So then you factor in zones of reversal, and that's where you start to partial along the way. So you're already starting to look at that bell curve. I was like, okay, well, this might not go all the way. So there's a chance it goes half the way. So let me take a profit here. So I thought, let me scrap all of that and let me just make it mechanical in my profit taking also, where I just optimize for my portfolio and the data I have, which was the bell curve is like this. Let me take most of my profit in the middle at the peak of the bell curve. So I know that from a smart money trader, which I'm not necessarily, but higher risk reward is very achievable in this day and age. The problem becomes the win rates. But high risk reward, most people can do. It's just how many losses you have and give it all back. Yes. So I thought, instead of me trying to hold these mammoth trades of 1 to 50, 1 to 30, whatever, and that's a rarer occasion, let me optimize, because it's harder to know what's going to happen at the end of the month. There's too many things that can happen along the way. But it's a lot easier to know what's going to happen during a London session or by the end of the day. It's a lot easier to understand that direction. So I thought, if I'm not optimizing for a final TP, which there's too many variables along the way on a higher time frame, let me optimize for a lower risk reward, and let me optimize for the day or the session. So then I started to take an approach of, let me cap every single trade at, let's say, a 1 to 10. And I have a discretionary approach. So mine became at a 1 to 3 risk reward, 50% volume, no matter what, and 100% volume at a 1 to 10. Even if it went further, I knew it was the outlier on my bell curve. And when I did that, I didn't have to change my win rate. I didn't have to change my strategy. I didn't have to change my entry models. Didn't really have to modify my psychology. I just had to optimize my profit taking, and my profitability adjusted off the back of that decision. Which is why it's interesting to me that you're saying still you have an approach of you want to have discretion in your profit taking. So talk me through your individual journey as I've had that reflection moment. What did you go through arriving to the decisions you have?
That's very interesting that you approach that model that way. So these are, again, these outliers, these anomalies that happen, you don't really care about them so much, right? Because you've maximized your curve by hitting the 10 to 1s in those scenarios. I'm just creating something at the moment. I've been working for a year. Essentially, I've revamped all of my content, and I'll explain why that links to that, because I believe I've become a better teacher, a better communicator over the years. I think 5 years ago, I wasn't communicating how I trade effectively, as I didn't come into trading to be a teacher. I was never a teacher. I was just a trader that happened to start helping people organically. I didn't create a big marketing campaign to launch a course. You know, 1,200 followers on IG. It was just people was asking me, and I was helping them, and it organically grew into this project Falcon. But I realized there's a lot of gaps. And before, from an ego point of view, I would take it personally, where people would say, no, you trade too much discretion. I'd say, no, I don't, because in my head, it's a very mechanical thought process. It's just I wasn't communicating that effectively, so there was too much discretion displayed, whether it be execution or management. So I've reshaped that, but upon reflection of looking at similar data, I've added in a new model, which is actually a mechanical-based hedge for these trades for management. So there's two ways that I can approach it. I don't recommend it for beginners, but for more of our funded traders, they know what they're doing. And it's more situational to what's happening in the current times. Like, for example, CPI, that never used to be as volatile as what it was. The same way NFP for years
used to be a lot more.
And then wasn't, you know. So you have to be, you know, agile enough to think that the market is never just the same. And I've been doing it 15 years, so I've seen a lot of different things, recessions, etc. And I've realized the smartest thing over the last year of data, if I would have had more of a mechanical approach to my management in certain areas on the intradays, I would have actually walked away with more profit. And the anomalies that run for like your 16%, it doesn't matter, right? But I've done it with a Fibonacci tool just to keep it very simple. But I'm looking forward to it because that's coming out with our mechanics at the moment. And I think it's going to be a big catalyst for those that are using too much discretion in management and essentially leaving too much profit on the table and not really knowing how to deal with that scenario.
The point you said of as you've taught more, you've got better at teaching, and naturally so it's a skill set that you've developed over the years and identified the weaknesses in your teaching approach and rectified them. And that for me is now, highlighted that you come in as a mentor, let's say, and that's the word that is thrown around, mentor. And mentor means something specific, which is I'm going to show you what I've done and you can copy what I've done. That's a mentor.
Yeah.
But an educator and a mentor is actually something different. An educator is teaching someone how to think, teaching someone where to look and how to do it themselves. A mentor is, this is what I did, copy me. Mentorship in certain approaches works because in certain industries it works better. Like, let's say business consulting. This is how I scaled my business. It will probably work for you because you're in the same industry and so forth. But in trading, there's too much individualism. There's too much individual psychology and so forth, where it makes more sense to give them the tools themselves and the first principles to arrive to their own conclusions and know how to look at their data, know how to build their own models and so forth. What do you believe are the first principles for a trader to focus their attention on, to build themselves up, not relying on a mentor?
I think that you need to really address the thought pattern of who you're learning from, right? So you can build within yourself, right? Joe Dispenza says it perfectly. Your personality is creating your personal reality, right? So if your personality is broken, that's just going to create a broken personal reality, right? So I don't want traders becoming a version of me. I want them to be the version of themselves. So for example, I'm very good at high up in the run of being very aggressive. Some people, their personality may not be suited to that. I don't want them to try to replicate me. I'll give them the tools and the infrastructure to trade the way that I trade, but within the parameters of who they are. Like some people, as you've probably met, they're just very conservative by nature. And it's not actually within their interest to now try to be an aggressive person. Be good at what you're good at. It might mean you have to sacrifice a little bit of risk reward, that's fine, but you'll be consistent. So I'd rather you be consistent than trying to chase who I am. Analyze my thought process on how I'm doing things, whether it be my routines, whether it be how I think about risk, how I think about capital partitioning, how I think about utilizing your money for leverage, what you're actually going to do with trade. And I always think beyond that. I don't actually see myself as someone who is teaching someone to trade per se. I see myself as someone who's teaching someone how to build wealth, and trading is the vehicle to do that.
Right.
Like my passion doesn't lie in candlesticks.
It doesn't end there, yes.
That's why recently we launched the mastermind that you refer to as the property fund. So essentially, the property fund is an avenue where people can build passive income. Because I see it like this: if I only teach you to trade, I fail you. Because if I disappear in 5 years and decide, look, don't want to do this anymore, then what? You've been reliant on me. I've guided you. You're probably going to lose a sense of the assurances of what you said to build up that independence. But eventually you do need good people around you, and there's going to be situations that happen that you don't know how to navigate and deal with yourself. So I thought, how do I truly serve these students that is going to stand the test of time? I need to teach them how to actually use their money correctly. And I would say I'm more passionate about that. It just so happens that the strategy helps them get there. So with our property fund, my brother's been a property developer for like 22 years. I've been in property. So I thought, how could we actually help these people earn passive income that's way more than an index fund, better than dollar cost averaging, and just get like real sites they can go to in person and see. That's going to give them the option at higher levels in our funded traders club. They're able to, when they've got 500K, you don't think it's a problem until you have money, is what I always say to them, right? You don't think your money's at risk. It's because your money's not at risk. You don't have enough for it to be at risk. But as soon as you've got capital, that needs to go somewhere. And this idea of thinking, well, I'll just trade it. You can't just trade all your money. You're going to need something like multiple sources of income. So that was kind of my hedge of...
There's a topic I'd like to touch on, but before we pivot into that, because I feel like there's a kind of worms.
Of course,
there's a couple of things I want to touch on to finalize, let's say, more of the trading side. So there are sorts of things that are in our control and out of our control. For example, the market is out of our control. There's nothing we can do. Despite what we try to do, the market is going to do whatever it wants. Despite what your smart money tells you, the market will do as it pleases. But there are certain things that are totally in our control, and it's limited to a few things. Off the top of my head, we have our risk. That's something we can control and we choose to modify. Our profit taking is another thing we can choose to control. Risk to reward is something based on our setup. We can see where what kind of risk reward approach we want. Our win rates, something I didn't think was in my control. I thought the win rate is given to me based on my approach, but I realized, no, I can choose my win rates. If I take a more aggressive approach to the market, if I want higher trade volume, my win rate is naturally going to come down because I can't take the best setups because they're not as frequent. So then I realized, okay, win rates is something in my control. And then if you model it out, you can choose your win rates. So I keep it in a select buffer. And if my win rates are going lower, I just eliminate hedge trades, counter trend trades, and my win rate will come back up. And at the other side, if my win rate is higher than my range, well, I can lower it because I want to increase trade frequency, and you can optimize everything. There's probably a couple other controllable variables that I maybe don't remember right now. Or your strategy, for example, the confluences you choose, the trade models you have. So out of these controlled variables that we have in the market, and maybe you can think of a couple more, what are the ones that are highest yield, or what are the ones that are going to be that 80-20, where if you focus on these one or two things, that's your strongest bet as a trader?
I would say your strongest bet is going to be lots of things that you already covered, because those are really the core of what you're talking about that you need to have in place. And then you need some form of routine that's going to allow you to stick to that. So it's going to be actually everything else connected to that. Okay. I don't think a trader can perform with this, laptop lifestyle. Right, because essentially you being a great trader is actually being quite methodical. So let's say if you're a session trader, you're saying, right, I don't take trades out of session. Well, then if you're flying all over the world and you've bought into that image, you're going to mess up at some point and it will affect you. So it's prioritizing the things that, what is going to help me be a peak performer? And if that means that, right, I need discipline before I go to sleep. Like, how many traders do you hear talk about, I've got a really solid evening routine? Because they're not thinking about these things, because they don't think that they connect. They think they can just wake up every day and just be who they are and it's going to work. But it doesn't, because they make emotional decisions. So if you're controlling your risk, you've got a good trading plan, it's as black and white as possible, you know your profit taking. You mentioned about counter trend trades. I have a model on counter trend as well, which I will only aim for a certain risk to reward. I will cap it at 5-1. And if it doesn't have the room for a 5-1, I won't entertain it. I'll say, right. So I've got those metrics in place as well, which is why I often say people confuse what we do as it's like guesswork, when the reality is it's actually very rule-based, what we do. But the routines part is the most underlooked thing that plays such a vital role. I spoke about this on Riz's podcast, and I'll just mention it now because it's very quick. First 15 minutes of the day dictates most of your day. Most people wake up thinking about their problems, they're stressed out, thinking about what they got to do. If you could just control the first 15 minutes of your day and lean into different things, as a practical tip for the people listening, you would see a direct influence of how your day is, and that would influence you on how you trade. So if you're trading London session only, for example, well, then that's probably pretty important, especially if you're in the UK or Europe time zone. You want to make sure you wake up and the first 15 minutes, you're not thinking about your phone, you're not thinking about what you've got to do. You're just thinking about what you're grateful for, what you're excited to do. And if you just control that thought just in those first 15 minutes, you'll massively see a difference in just how you operate. Because most traders, they're in a bad mood. They're looking at the trade like, how do you think that's not going to affect you taking a trade in that London session?
Mark, that was something that I used to hear on the internet, and I always used to think that's wishy-washy advice. Like it sounds like that hippie stuff. And then I read into it a little bit more, and it was a guy basically saying when you take a decision that was wrong and you knew it was wrong, and it's only when you've left that moment and you look back and you think, why did I do that? That's very analogous to a trader that knows they shouldn't have taken that trade, but they took it anyway, and they call it revenge trading. Well, they say, or they're thinking that was a psychological problem that they just arrived to, which it could be. It could be a trauma or something. It could be anything.
Of course.
But there's also that just thing you said of how you started your day, and I forgot where I got it from, but it was a guy saying, when you wake up and you reach for your phone and you see some emails or a message, you've already got a microdose of stress, something to attend to, something on your mind. And then you get up and then, your partner's in a bad mood, and then that rubs on you, another micro stress. Or you're running late, so you got to drop the kids off, they're running late, another micro stress. And he's like, if you accumulate all these micro stresses along the day, by the time you've arrived to your desk and you're about to take a trade, you've accumulated this, and you might be at a threshold where you might now take an irrational decision. And then when you only calm down and look back, like, why did I do that? I don't know where that came from. Maybe it's psychological issues, or maybe it was just your day. It was just how you started your day. So I'm in agreement with that. The last thing I want to touch on trading is you said something around the lines of follow the money. And that sounds like to me you're wanting to trade with where the volume is and meaningful moves. So as you said, counter trend isn't your objective. It's the main trend, because that's where the money is going. Now, that is something that a lot of people ascribe to. Trend is your friend, and you want to trade the meaningful moves. But not everyone knows how to get there. So what is it for you in your specific confluences that helps or protects you or helps you arrive to understanding what would be a meaningful move in the market, as opposed to a fake out or a counter trend? How do you establish this is a meaningful move and this is where I want to put in my volume?
That's an interesting perspective, because there are lots of traps in the market that you won't be able to see. Higher time frame, firstly, so I'm talking monthly for overall positioning. I'm rarely, as you can tell, I'm rarely spending time on the monthly because it takes 2 seconds to look. Just see where you're positioned in the first place. Then I'm working my way down to the weekly, seeing where the major swing highs are. But I'm looking for something very specific. So you either have the build up of volume or you have the sharper moves. I'm more interested in the sharper moves. So, you know, where, for example, you see on, let's call it the daily time frame, which is one of my favorite time frames to look at, you know, the daily direction. You'll see, rather than just consolidation for weeks on weeks, you've got about 5 or 6 days of price, and it's moved up very, very sharp. And then you've had, let's say, for example, a big sell-off, right? That's the area. That's my area of like the higher time frame narrative. This is the highest form of value, that when we're positioned there, if I get all of the right signs, I want to be in the continuation of the trend at that point. That's my priority. If I'm not within there, then I need to look at more micro areas of value. But it's the flatness versus the sharpness that, for me, from my data anyway, that dictates the probability of the trade itself. So from what I found is that when there's these sharper moves, I refer to them as hook points. Someone's going to tell me, even probably in the comments, that it's this or a POI or whatever it is, right? I just call it hook point. And within that area, that is what I prioritize the most. So I can go, right, the daily is sharp. And I know that even on the micro time frames, this is a beautiful thing about it. What I found is that my better trades that don't really move too far away from the entry point, don't really go into too much drawdown, are the sharper points versus the flat points. So let's say, for example, someone has an area that they call liquidity. They're looking for price to tap into that. I might be looking for the same thing, but I'll just be looking at it from a more structural approach to that. But if it's sharper versus flatter, it produces a different outcome for me. And it doesn't move too far away from that area. So I can look at those points and go, right, this is sharp, that's flat. I know there's a different variable there of what's more likely to play out.
It's a form of momentum, and intention shows you the direction. There's a point that I feel a lot of traders arrive to, like we spoke about psychology, also in their technicals, where once you've done 3-4 reputable courses, once you've watched a decent amount of YouTube videos, you've arrived to know majority schools of thought and the majority of confirmations and confluences people have. There's nuance in each person and each strategy, let's say, but they'll arrive to a similar place. And the stats show that that's not enough. And it's actually the deployment of that and how you build it together into a trade model. So it's not a case of I know these 10 confluences. It's what are my non-negotiable confluences that I need no matter what. Where if I have 8 good confluences, but I'm missing these 2, even though I have 8 confluences where someone might say, I've got 8, I'll take it, I still can't take that trade because I'm missing the non-negotiables, for example. Or how can I build a hierarchy of them to know what is more probable confluences and less? Because at this point, everybody knows a trading confluence and what is going to be conducive to an edge, but it's actually how you connect them and deploy them is where the magic happens. In your approach to the market, what would be your top 1, 2, or 3 approaches or specific confluences that you see? These are the ones I need. These are the ones I need in almost every trade. No matter if I have everything else, these are the ones I always need from a technical perspective.
From a technical perspective, I want to make sure that I've got the high time frame narrative within my favor. I'll say number 1, I want to trade as much as possible with the high time frame. Counter trades, very few. So I could almost say, if you said, Mark, you can't take any counter trend trades ever again, I'd be like, fine, they're an anomaly anyway, so it doesn't matter. So I'll focus on high time frame narrative. I want to make sure that there's an area of liquidity available that price has sold off from, because I'm mainly taking shorts. I will take buys as well. And I want to see price pull up into that area from a structural perspective. If I have structure there, I will have what I call an insurance entry. If I don't have structure there, but it taps into the liquidity itself, I will take the first continuation. So it's really an element of high time frame narrative. Where is the volume? Where's the liquidity? And then the next part is being specific with my entry type. And I have 2 entry types. I'm either taking it within a structure or I'm taking it on a breakout of a structure that is already in continuation. I would say those are my 3 key things. If you took everything else away, I'd be fine with that. You know, and if there's going to be variations, for example, that if it's building up a lot of consolidation leading into that area of liquidity, if there's lots of wicks there, let's say there's a 4-hour bullish wick, I know that wick is likely to be filled into that area. So if there's an entry that arises in the middle of there that might fit my plan, this is why I'm never in agreement of take every trade that fits your plan, because certain things are situational. Well, I would look at that and see that that's a 4-hour bullish wick, that's likely to be filled, and it's going to gravitate back towards the liquidity anyway. So why would I just take a trade now, take a random loss? It's not worth it. So I know you can't control everything, but there's certain variables in the market that's where the discretion comes in, and that's people that they want to avoid it, they don't like it. But I think there is a middle ground and an edge that you can find in it when you understand how to deal with it.
Brilliant. I'm in agreement. These are very logical, sound places to have as non-negotiables. Now, there's also that thing we touched upon of the things in our control, the variables that are in our control. And you also mentioned that people have unrealistic expectations coming in. And because you've been 15 years in the game, you've seen the pendulum swing, you've seen all of the marketing campaigns and all of the fluff in the industry. What would you say for a trader of what is realistic in terms of what is a realistic win rate? What is a realistic risk to reward? What is a realistic gain, trade frequency? What is normal and in a professional approach that you've seen in the traders that have been with you or yourself for more than 5 years?
A win rate, I think you could very much aim for over a 50% win rate. And I know there's going to be people that have a little bit less and they still make it work, but having over a 50% win rate, just from a psychological standpoint, I think is a more healthier approach. From a return point of view, it's going to be strategy dependent, but aiming for these big returns, I just don't think it's going to work longer term, because it skews your understanding as to what is possible in the markets, and you'll forever chase that dopamine hit, right? Yes. So that's another area that traders should focus on, but actually build a plan. That actually know and do the numbers. Like, most people obsess over capital goals, but they don't really know what they're going to do with that money. They don't know what it's going to give them, right? So if I say to a trader, right, they want to trade 400K. I was like, right, so what does your lifestyle look right now? How much are your expenses? What's the plan? That most people, they don't take themselves seriously, and they wonder why they don't get there in the first place. Realistically, you can make 5% per month. I'm sure people are going to say, oh, you can make more than that. But at 5% a month on average, on a decent sized capital, you can live a top 1% life. And if you stop fantasizing over the bigger returns, and it's not for me to say, look, don't do your 3-to-1s. I don't want people to miscommunicate. It's not about that. It's about understand what comes with the territory of all these different things. So one thing you might say, I'm comfortable with that, but then equally you're not comfortable being in drawdown for a long time. So which one is it? You're either comfortable or you're not. You need to know what the pros and the cons are for different things. And I think what I've done very good is communicating to our students is this is what comes with the territory of these specific things. So realistic returns, I mean, what is realistic? But from an average trader, I would say if you're hitting 40 to 50% a year, don't compare yourself to the person who's hit 2,000% on something super aggressive and thinking you can emulate that. And if you were to actually look at the numbers and go, right, on £1 million of capital that's within reason, how much money am I making after profit splits? If you're making 250K, 300K a year, like, do the numbers after taxes, you can work it out. You're making £18,000 a month. Most of these people are not making more than 2K, and they're chasing a 1,000% return. Where if they actually worked it out, because they've done a study, right, which is they looked at what is the top area of money per year that someone would need where their happiness doesn't really increase after that. I'm not sure if you've seen that study. And it was roughly about £60,000 a year, like give or take a few thousand. And then they studied it and said, right, if we increase the responsibility for these individuals and they earn 70K or 80K and it went up to something like 100, there was no increase in happiness, because people fundamentally just want their needs met. They want to know their mortgage or their rent or the bills, the slightly nicer car is taken care of. Like, don't obsess over these superficial things that are really and truly not going to make you happy in the long run anyway. I know that could be, well, that's your belief. That's fine, but we have millionaires that commit suicide. So money's not the answer. Fulfillment, relationships, from my perspective, has been the biggest thing. So if you could prioritize that and make a real game plan and say, look, I don't need to, it's not limited for you to want to earn £250,000 a year, because you can build after that. But incrementally scale up. Forget about the big numbers. Just get yourself to trading well on 100K. Have good discipline. Be proud of yourself that you can actually stick to that, and then you can scale from there.
You mentioned a buzzword, which is dopamine, or a keyword, actually, not even a buzzword, a keyword, because a lot of things are tied into it, and not only from chasing the big numbers, that's maybe dopamine orientated, or they believe dopamine will come from if I buy X materialistic thing, but also on a day-to-day level, it's the hormone of motivation, is what keeps us going. And I think prop firms and the industry has hacked that to be like, okay, you can, instead of having dopamine release on an X amount payout and actually achieving something, you can get a dopamine hit on passing a challenge and getting that certificate and posting it online. You get a dopamine hit. And I think that's where a lot of people's pitfalls can come from, where they're not understanding dopamine or not understand cheap dopamine, access to cheap dopamine. What is your approach to that topic in general, the word of dopamine?
Dopamine is something that you need to know where it's coming from, because you're getting it everywhere. You mentioned about the phone earlier. People get it from the phone, they get it from somewhere else, they're getting it from likes, they're getting it from the cool picture that they took. Whatever it is, people don't realize it's happening, and you need to look at your triggers and your patterns at every facet of your life and thinking, where am I getting this? Where is it coming from? And if you can just write, most people have never written this down. When was the last time anyone took a sheet of paper, wrote dopamine, and just actually figured out, where am I getting it from?
Right.
You fix things by bringing awareness to it. It's not actually complicated. Like even in Rewired, things like this, people think, going to give this magical formula. It's not. It's about learning the process of bringing awareness to something to then have something in place to interrupt it when it happens, to then not do it. So I give a very simple one. Let's say you're someone who's thinking really negatively all the time, and you've now brought awareness to it. I tend to have a lot of self-doubt. The moment you get that thought of self-doubt, you need to address it and say, that's an error thought. Right, this is, and then you ask the question, is this thought useful right now? Your logical brain will take over and go, no. And it might not work in that one scenario. But you do that 20 times, eventually you'll do it less, and you'll find yourself not thinking negatively. Now, I'm not saying that's a fix for a quick fix, but if you do that at every area, eventually you'll realize that dopamine, every single time that you feel the dopamine, you ask yourself, is this dopamine useful to me right now? No, it's not, because logical brain would take over. It can't in the moment, because the dopamine is going to be emotionally driven.
Yes.
So you can stop it there and then. And if you do it enough and just give yourself a bit of time, eventually you'll realize these things, they're not useful to me, and you'll almost be disgusted that you're getting dopamine from them in the first place. And then the goal is to just reduce it. You'll never get rid of it indefinitely. We all will find elements of dopamine regardless. There is no way in a million years, if I drop a YouTube video next week and it gets 1 million views overnight, that I'm not going to have dopamine. And I'm aware of it myself. It's just, how can we reduce it?
Okay. Now, to bring the episode full circle and conclude, in the beginning you mentioned that people get into the industry because they're chasing freedom. It boils down to a lot of things, but freedom was one of them. And freedom can mean a lot of things to a lot of people, and people will prioritize certain things over others. And trading definitely can give you freedoms, but not absolute freedom. It will maybe give you an element of financial freedom, but it won't give you time freedom, for example, or geographical freedom. If you need to be at a desk, you need to be in an environment, so you haven't got full freedoms. So now when you're speaking about your ascension or wealth plan beyond trading to, I guess, factor in for complete freedom, what is that after trading life look like, or how to deploy your capital? Where are the areas that you think is financial literacy and growing in that element?
You said the word financial literacy, and that's so important. When you said the word freedom, I spoke about imagery after. As soon as you said the word freedom, I was thinking of passive income. So it's interesting how everyone is thinking about that differently. I'm not thinking about freedom because I can go travel to France and trade on a laptop. I was thinking, am I leveraged or not? Right? I don't want to be leveraged. So how do I put myself in a position to not be leveraged? Well, I need to be God forbid anything happen to myself. How am my family protected? How am I taking care of them? I have lots of responsibilities that I've taken care of my mum and dad over the years. I built them a home. I made sure that everything was looked after. That was my priority, because I thought, well, if I can't trade, what if something happened to me? What if there was an actual cognitive issue and that I couldn't trust myself to trade with capital that I've got access to? I'd have to give it all back. What am I then going to do? Rely on my family and say, like, no, it's your problem now. And the traders are not thinking, because they're thinking too short term, because you never think it's going to happen to you until it does. You never drive a car and then don't put your seatbelt on and think, well, it never happened to me. But you don't put it on and think, oh, it will just never happen. You put it as an insurance. So it's not fear, it's just understanding reality. And I think the biggest thing that someone could put in place is just putting things in place for their family, so they know that they've got the freedom of mind. That's what kind of comes to me. It's like, do you have the peace of mind knowing they're looked after? But what's the how? How do you do it? Well, I know property, so I can mention stuff about crypto, but you're tied into something for maybe 5-6 years. You don't know when something's going to shift. But what you can go for is tangible assets. And my thing is property. And that's why we created the property fund, because if traders have got 400, 500K. They've built it up from prop firms over a period of time. And I believe prop firms are good, by the way. I know sometimes I might come across as if like it's gamified, as if I don't like it. I think it's an incredible stepping stone.
It's a wonderful
Just
opportunity,
please prioritize your personal capital as well, like build up that capital. But let's say a trader comes to me and said, look, I've been doing very well for 3 years. I've worked my ass off. I've been really good financial discipline. I've got 500K. What do I do with it? Either put it into a commercial real estate or put it into our property fund. Let's say, for example, you want to go commercial real estate. You could tie yourself into a 10, 20-year contract with a company. You don't need to deal with any headache, no management. You get paid quarterly. You're getting that yield from it, right? It could just be a unit, for example. I'm just going to ones that I'm involved in. If you're going to get, let's say, 10% on that, 10% would be on the higher end, but there are scenarios. But just for simple math, you've got 500K invested, 50K a year. You're paid quarterly, you don't do anything. What's the risks? Well, if they leave, they pay you a big penalty anyway, right? So you're not, you don't have a headache. And if that's kept for your family, for 20 years and the contract would just be renewed, 50 grand a year comes in whether you lift a finger or not. How is that not freedom? Freedom is not just your laptop and then you trade London session only. You've gone from an employee to the session, right? And that's fine, but there needs to be an end goal. And that's why I said that I don't see myself as just an educator for trading. I see it as I'm actually helping these people build wealth the best way that I know how. I could recommend, look, I agree with this crypto, I agree with this stock, but I know there's so many variables in that I don't know or can't control. But the property side of things, I can get them into a real property that's going to pay them passive income for life. And that's going to be there to take care of their family.
Brilliant stuff. Mark, thank you very much for coming on. The hour flew by. I think it's beyond an hour, but a very insightful conversation. And I allowed a bit more time because you were going really in depth. And I personally very enjoyed it. So thank you very much, Mark, for coming on. And maybe sometime soon when you're back in Dubai, second home, we'll do another part 2, more on the business side. But thank you for coming on.
Definitely. Been an absolute pleasure. Thank you for having me on.